Right, let's jump straight into this explainer and look at exactly why the commercial real estate market is bracing for a massive impact. We aren't just talking about a few empty office buildings here. No, we are talking about a slow-moving, trillion-dollar collision that has financial experts, regional banks, and market watchers completely on edge.
You know, it's a fascinating paradox. Why on earth are sophisticated investors, the people with immense capital who own the massive office towers and sprawling apartment complexes in your city, suddenly facing foreclosure? I mean, these are individuals and institutions that employ absolute armies of analysts, and yet they're walking right into a financial buzzsaw. To understand why this is happening, we first have to understand the fundamental rules of the game they're playing, because those rules are very, very different from the ones you and I play by when we borrow money.
Section 1. A tale of two loans.
To really grasp why property owners are struggling so badly to refinance today, I want you to picture an analogy. A standard residential mortgage, the kind you or I might get for a house, is basically a 30-year cruise. You lock in your ticket price, you get a fixed interest rate, and you have these incredibly predictable, unmoving monthly payments. As long as you pay your ticket every month, it's smooth sailing all the way to your destination 3 decades later. But a commercial loan, that is a 5-year high-wire act. It's a totally volatile environment where balance, timing, and sudden shifts in the wind dictate everything. And most importantly, it ends not with a gentle docking at the port, but with a massive, forced jump. The mechanics behind that high-wire act are honestly brutal. Unlike your home loan, commercial loans might be calculated or amortized over 20 or 25 years, but that's purely to keep the monthly payments manageable. The reality is, the bank doesn't wait 25 years to get its principal back. The loan actually matures in just 5 to 10 years. Boom! The bank demands the full remaining balance in one giant lump sum. We call this the balloon payoff. So when commercial owners reach the end of that wire, they can't just keep paying their usual monthly bill. They have to execute a daring jump to secure a brand new loan just to pay off the old one. And here's the kicker. That brand new loan is entirely dependent on the property's current cash flow and whatever the market's interest rates happen to be on that exact day.
Let's look at Section 2, hitting the maturity goal.
So that obstacle on the tracks, it is massive. Data from Franklin Templeton shows a staggering $1.2 trillion in total commercial real estate loan maturities coming due. Think about that number. This isn't some slow trickle of debt that can be comfortably paid back over time. This is a hard stop. Borrowers must suddenly find brand new financing for $1.2 trillion worth of outstanding loans, and they have to do it right now. If we look specifically at 2025, over $500 billion, well, $534 billion to be exact, is coming due in just this 1 year. We're looking at $257 billion in multifamily residential loans, $206 billion in office loans, and $71 billion in retail loans. Each one of these individual property owners now has to walk into a bank and convince them to write a completely new loan to cover the old one. But the financial environment they are jumping into today, it has entirely transformed from the one they left 5 years ago.
Which brings us to Section 3, the 1-2 punch.
The first punch is basically the wind threatening to blow them right off that high wire. The Federal Reserve hiked interest rates from near zero to over 5% at the fastest pace we've seen since the inflation-busting era of the 1980s. Just a few years ago, commercial money was cheap, right? You could finance a skyscraper for 3 or 4%. Today, the cost of borrowing has essentially doubled. That makes the monthly payments on that desperately needed new loan incredibly expensive. Then, the second punch is the shrinking safety net, loan-to-value, or LTV ratios. Banks only lend a certain percentage of a property's appraised value, usually sitting around 65 to 80%. Let's walk through the math on this really quickly, because it is literally the core of the crisis. Imagine your building was worth $100 million 5 years ago, and you got a $65 million loan. Perfect sense, right? But today, because interest rates soared and demand dropped, that exact same building is only valued at $75 million. Now, that old $65 million loan is way too big of a percentage for the bank to swallow on a $75 million asset. To get a new loan, the math just doesn't work anymore. You have to inject millions in cold, hard cash out of your own pocket just to right-size the loan and hit the required LTV ratio. And if you don't have those millions sitting around in spare cash, you fall. To ground this in reality, let's look at a real-world story. 145 South Wells Office Tower. This was a $57 million 20-story building. Their loan originated in early 2020 at a sweet, incredibly cheap 3.1% interest rate. But fast forward to their maturity wall. Rates were sitting at 7%.
Combine that with terribly low occupancy from the permanent work from home shift, and their net operating income simply couldn't support a new, vastly more expensive loan. They just couldn't survive the jump from the 2020 economy to the present day. The result? Total foreclosure in 2024.
Now, this 1-2 punch isn't landing evenly across the board. It's heavily targeting specific sectors. While overall delinquency rates are rising everywhere, the office sector has absolutely skyrocketed, jumping from 3% to an alarming 17%. The combination of sky-high borrowing costs and empty work-from-home cubicles is proven to be an incredibly toxic mix for office landlords.
Moving to Section 4, Distress and Debt Overhang. $102.6 billion according to the MSCI U.S. Distress Tracker. That number is the actual balance of distress in the U.S. commercial real estate market as of late 2024. And remember that massive spike in office delinquencies we just talked about? Well, office buildings make up nearly half of this massive $100 billion pool of troubled assets. But the damage isn't just happening on bank ledgers and in court foreclosures. It's showing up in the creeping physical decay of the buildings themselves. Researchers at UC Berkeley Haas identified a fascinating phenomenon they call debt overhang. Essentially, when a landlord does the math and realizes they probably won't be able to refinance and might actually lose the building, they completely stop investing in it. They won't renovate spaces for new tenants, they won't upgrade the HVAC system, and they outright ignore major repairs. And honestly, from a behavioral economic standpoint, it makes total sense. Why would you spend millions of your own money to improve a building that the bank is about to take away from you?
Because of this, the Berkeley study found a direct, causal link between the timeline of the loan and the actual health of the physical building. Properties facing imminent loan rollovers, those right at the very edge of the high wire, suffer sharp drops in net operating income and rapidly declining occupancy rates. It's the looming debt itself that's causing the physical degradation. Meanwhile, identical buildings across the street that just so happen to have distant loan maturity dates, they perform just fine. Those owners aren't paralyzed by a looming wall, so they're still actively investing in tenant renovations and property upkeep.
And hey, even if these distressed landlords try to bail out and sell the property before they fall off the wire, they are completely trapped. As the researchers noted, sales conducted under rollover risk are associated with discounts in property value. The sheer desperation of the ticking clock and that looming maturity wall forces severe price discounts, sometimes up to 13% lower than comparable properties that aren't facing an immediate refinancing deadline. That is a massive amount of equity completely wiped out just by the timeline of a loan. Section 5, what happens next? When maturity hits, a borrower essentially faces 3 doors. Door number 1, the loan gets paid off, either with a massive cash injection or a successful refinance. Under current market conditions, this is incredibly hard. Door number 2, the lender forecloses, taking back the asset and dealing with the mess themselves. Or door number 3, the loan is modified and restructured. This is often called extend and pretend, where the bank just kicks the can down the road a few more years, praying for better economic weather and lower rates before they actually have to face the music. Now, why this matters to you, to all of us really, is that this isn't just a localized landlord problem, it is a systemic banking problem. Over 50% of all bank commercial real estate loans mature before the end of 2026. But it's not the giant, diversified megabanks like Chase or Bank of America holding most of this risk. It's the regional banks across the country that hold massive concentrations of this specific commercial debt. If property owners can't make those massive cash equity injections to right-size their loans, these regional banks are going to be forced to take devastating losses on foreclosed buildings, threatening a broader banking crisis in communities everywhere. So it leaves us with a massive, critical question about the structural future of our financial system. This collision is already happening in slow motion. As $1.5 trillion in commercial debt races toward this maturity wall over the next few years, will the banking sector find a way to catch these falling properties? Or will they be forced to let them fall, absorbing a massive financial shockwave that could rattle the entire broader economy? We're definitely going to have to keep a very close eye on those regional bank balance sheets.